So one of the things I was doing this morning is I was writing a quick little paragraph on essentially what amounts to a trading idea or a trading tip, and thinking about, say, one thing that's a touchstone or a major contributor to my trading. It's a difficult thing. There's so many little things that we do right. Little things like looking at multiple time frames, or looking at different economic indicators, or looking at different patterns on a chart, my 34 EMA wave, or my grab candles, whatever it is. There's so many little pieces that put together yield the information that I need to make a trading decision. So boiling it down to just one was kind of tough, but I kept thinking about it, and I thought, you know what, let's keep it simple. It's not an indicator, my wave or my grab candles, anything like that, on its own. What is the one thing that, if I were to say, is one of the more impactful and useful? I want this to be a tip that even if somebody didn't use the wave, or didn't use grab candles, or didn't use the kind of tools that I use, how could it still be applicable? Now, I think market trends are very applicable. Okay, I think regardless of your trading style, it's important to understand the trend of the market. And then I thought, you know what? What's the most important trend of the market outside of the actual chart that you're trading? Maybe even sometimes more important than the actual market trend or phase of the chart you're trading. And that is of the daily time frame. And so what I was writing about was basically the importance of that daily time frame to my trading. Now, as far as the daily goes, it wasn't always necessarily something that, early on, let me put it to you this way, early on, before the internet, before streaming intraday, live, affordable, real-time charts were available, real-time price action, back when I was trading commodities and stocks, was incredibly expensive. It was not an inexpensive thing to have. And it was very difficult because when I first started trading, we still had dial-up. So the internet really wasn't an integral part of your trading. It just wasn't. You were on the phone talking with your broker. You were on the phone getting a quote from an automated line. And you were typically updating charts manually by hand that arrived, say, once a week. You'd update them manually for the week, and then another set would come typically the following Monday. So it was definitely a challenge. And you were on, and you know what, I shouldn't say it was a challenge, because we didn't know any better. There wasn't that much else you could do except for either go to Chicago or New York or one of the exchanges, or work for a company that had access to, say, like a Bloomberg machine or something. Okay, there were real-time charts, and intraday trading was kind of out of reach when I first began. So my trading was the daily chart. So I have a great affinity for the daily chart because that was my way of viewing the market. The neat thing was, you could take your time. You could take all the time you needed looking at a daily chart, because you were only getting one new candle every day. It wasn't a rushed process whatsoever. And usually my daily chart trading would be a lot of trend line drawing, a lot of 50% Fibonacci's. Okay, I would use a 20 period close, like momentum, simple moving average type indicator. Remember, even indicators, you had to calculate by hand. You couldn't assume that some of the charts that I had delivered to me on Monday had a number of indicators that were included on that book of charts. But who knew if they were going to use a setting you wanted to use, and so forth. So, and then the remainder of the days, you'd have to calculate them yourself. And I think we take for granted the calculation of, say, an MACD histogram. We just turn it on in the chart. Back then, it was a calculation. So you found yourself using very simple tools, looking at very little data, and taking your time making a decision. And in a lot of ways, it saddens me that traders nowadays don't get that simplicity. Remember, I wasn't being bombarded by internet emails about different courses, seminars, books, tapes, whatever it may be. You kind of learn in a bubble. You are very isolated, and while that sounds like a negative, it really was a positive, because you could learn at your own pace, and you just kind of put your ideas together on your own. So I think if you talk to traders who learned how to trade really before the internet era, and were teaching themselves how to trade back then, you'll find they have kind of, I don't want to use the word old-fashioned, but they have more traditional, classic ways of looking at the market, because that's what influenced them the most. So you know that, and I've mentioned these names before, Richard Schabacher, number one, as far as anything that you're going to read on chart interpretation, technical analysis, and stock market profits, was the first book that really kind of broke down chart patterns and kind of introduced me to the world of charts. And this thing was written in the early 1900s. I want to say like the 1920s or something. Okay? So you think about Richard Schabacher, you can think about Richard Wyckoff. From Richard Wyckoff, I learned a lot about tape reading and so forth. There's a book out there now. You could probably download it for free. I've seen the PDF all over the internet. It's called the Day Traders, or it is called the Day Traders Bible, I believe. And it's a lot about understanding price, just the number itself, because you got to remember back in the days that traders would just look at a ticker tape. They could look at price and understand what was going on. Now, we put price, we graph it on a chart, and then we analyze, say, the trend line, support, resistance, and so forth. That's why, for me, chart patterns were a very natural place to go as far as where I started to evolve as a trader, and I've never abandoned those. So, kind of back to my daily chart. So that all these thoughts, all these things came as a result of my reliance on a daily chart for a good part of the early years of my trading. Again, back when I was doing predominantly commodity futures. The daily time frame has what I call the directional bias. And that simply means that the dominant psychology of the market, even more so than a weekly, I think the daily holds the key to what the market's psychology is. And what is the market psychology? How would we define that? Well, the market psychology to me is really just a extension of human psychology. I think a lot of times we forget that whether you use candles or whether you use bar charts, it's just human emotion being graphed in front of you. So if I'm trying to look at market psychology, I'm talking about human emotion, right? And for me, the most common emotions in the market are ones that I think all of us experience. They're fairly base human emotions. And you guys know these: fear, greed, confusion, and anticipation. And I'll even put in there boredom. And these are basically reflective of the four market phases, that Charles Dow talked about. So it kind of brings us full circle to those older books, those older writings that I used to read, and Dow theory. So all this, again, kind of stemmed from the fact that I had the time and could kind of interpret the market in my own way without someone telling me it's wrong, and all the judgment and all the sometimes hostility we see now in this more social place we call the internet. So that daily chart is where I will begin to assess what the dominant market psychology is, the directional bias. And that simply means I'm going to, at this point, use my, of course, 34 EMA wave and my grab candles to understand what the trend is. And the trend, of course, is made up of what? To me, the trend is made up of sentiment plus momentum. So I get my sentiment and momentum from my grab. I get my trend from my 34 EMA wave. And by starting on the daily, it's not that I'm going to trade the daily time frame. We're not talking about the daily because it's necessarily the most tradable. We're talking about it because it reflects the larger psychology, I think, in the best way. So if I were to go ahead and consider what a setup would be for me on the daily time frame, that doesn't mean I'm necessarily going to trade this daily. There may be a setup here, or there may not be. But what I want to do on this daily as I look at it, and I've been watching, one of the charts I've been watching pretty closely has been the Swissy, the dollar Swissy, is I've really been looking at this pair. I'm looking at the directional bias. Okay, I can see that within the look back we have here, which is basically 1 year. I'm looking at May to about late June. What color has dominated this view so far? If I were to look at just simple interpretation. Quick question here, right? What color has dominated my grab? Because that will give you an idea as to what? The sentiment and the momentum of the market. So very, very much a bearish market. I can see that also because of the angle of the 34 EMA wave. Okay? But we can see we've transitioned out of that downward sloping 4 to 6 o'clock angle a number of times. And here we are, hard right edge of the chart, trying to transition once again. Now, while the market is trickling lower in what has to be considered really a dominant bearish trend, but we have been transitioning out of it slowly and frequently. We see the green grab candles and the wave flattening out. We have these larger patterns, falling wedge, channel down, and what these provide for me are resistance levels. Now, remember back when I was saying I draw these lines and levels on my daily chart? Part of understanding what chart patterns were was just understanding they were the culmination of support, resistance, and trend lines. And here I have a number of downtrend lines, some acting as support, some acting as resistance, telling me that right now, when I look at this dollar Swissy, I am losing some of the bearish sentiment and momentum. The wave is trying to transition out of that downtrend. It has been doing that with more frequency. Okay, but I still have these larger resistance levels, these downtrend line resistance levels from these chart patterns that I think are psychologically important, because until we can get above those, it's likely that we won't be able to attract a lot of organized bullish sentiment. Now, I put the word in organized. Why do I mention organized? If sentiment organizes, enough people are bullish, it turns into momentum. If momentum organizes, it turns into a trend. So it's organized sentiment, people thinking or dominantly thinking the same way, that turns into that bullish or bearish momentum. When that momentum continues and starts to carry a pair higher or lower, any market, higher or lower, and it's the dominant opinion, even when it pulls back, people are going to be willing to support an uptrend, or even when it bounces, people are going to be willing to sell into a downtrend. So it's that organized momentum that turns into a trend. So right now, if I were to go back to the psychology that we're seeing within this channel down pattern, okay, I do have the selling pressure waiting at these downtrend lines, okay? But right now I can also see that there's definitely a more neutral type opinion in the market. It's kind of flattening out. So in this situation, looking at what I'm trying to interpret from this daily chart, there is really no dominant bullish or bearish trend. It's more like the confusion I talked about, or that anticipation, boredom. Anticipation and boredom, I know, are not the same emotions, but what they yield on the chart is the same. Anticipation flattens a market out, narrows the range. Boredom flattens a market out, narrows a range. It's usually anticipation. It's usually the market waiting on something, or it's low volume. So, if I were to use, basic fear, greed, confusion, anticipation, I want you considering confusion to be that wide sideways range. Okay, bigger difference between what the bulls and bears think the market should be doing, wider range between the floor and ceiling, versus the narrow range of anticipation. Everyone's waiting on something. Nobody wants to stick their neck out, usually in front of different events, economic data, things of that nature. Okay? We've seen the price action. I'm just labeling with some sort of psychology, because understanding what people are thinking gives you a good idea as to how they may react. So right now, I've lost a dominant psychology on the Swissy. In fact, over the course of the US dollar index's bounce, one of the results of the bounce off the 73 area in the dollar index and this testing of 76 on the US dollar index contract, futures contract, is the fact that our trends, we had very strong trends for quite some time on a number of markets. The downtrend on the dollar Canada, the uptrend on the euro US dollar. We had a number of very strong trends. And with the bounce in the dollar index was in a very strong downtrend. With the bounce there, the directional bias has shifted, and in some cases shifted in a very significant way, in terms of what was once good support above the wave to now being possibly resistance. I think the euro US dollar is dealing with this right now. The dollar yen is dealing with this right now. The Aussie is testing the wave but hasn't broken down like the euro US dollar has. But you can see the shift in the directional bias is going to change the kind of patterns I'm considering. The shift in the directional bias is also going to change what kind of trades I might take intraday on specific time frames. When we have strong trends like we had on the Aussie for much of March and much of April, for all of April, I'm not going to take a counter trend trade on a longer term intraday time frame. In other words, when I've got an uptrend, when I've got a dominant psychology clearly bullish on the daily, if I do want to get short, it's going to be on shorter term time frames, 5, 15, 30. So when I look at the shift we're seeing right now in the Aussie, when I look at a 15-minute short, this would have been a viable opportunity regardless, because it is a short-term time frame. But now I also know I'm dealing with this short within what is kind of a range-bound market on the daily chart. Again, the daily's focus, or my focus on the daily, comes from my feeling that it is the most dominant, the most important psychology. And I don't want to fight that. It's like swimming upstream. If I know what the dominant trend is, I'd rather work with it. In a dominant trend, uptrend, I want to position myself at support. It's a higher percentage play. In a downtrend, I want to position myself at resistance. Again, it's a higher percentage, lower risk play. Okay? So, swing trades in the 15-minute Aussie. If prices bounce up to the area between the 20 period simple and the 34 EMA low, that's a swing short for me. Something we can consider for an entry short. But just remember the trend on the Aussie, or the lack of trend, and the sideways price movement on the Aussie right now. Ask yourself, what could be the cause of it? For me, right now, I still feel much of it's the dollar index. And as long as that's the situation, it's going to be a bit of a challenge. For those of you out there who are saying to yourself, the price action has been pretty challenging unless I've been on a very short-term time frame. You're right. It's been my opinion too, that sticking to short-term time frames right now, because of the way the dollar index is behaving, is probably the better way to view the market. Okay? We've had very range-bound candles, sideways markets on our daily charts, and I think it's been making it much more difficult to see that larger follow-through that we've really become accustomed to. With the dollar sinking, we've had very strong trends. Those trends are transitioning out. The psychology is changing, and we must adapt. And I think the way you adapt is by recognizing what's going on in that daily chart first, and then looking at the intraday charts after that.